Hello everyone, welcome to Shantha Lakshmi IAS. Since few days we have been witnessing, right, our Indian rupee is under pressure, that it is weakening or depreciating. So in this video, let us discuss about this concept very comprehensively. Why our Indian rupee is under pressure and what are the impacts of this and what needs to be done. So to begin with, what is the context in which we are discussing this concept? For the first time in history of India, our Indian rupee has breached the exchange rate level of 80 to the US dollar. That means for $1 worth rupees good, we need to give 80 rupees. It has depreciated. Indian rupee has been depreciated, right? So now, before we go into the discussion of this, our topic of the video, that is why the Indian rupee is under pressure, first let us understand the basic terminology regarding this. So what is this rupee exchange rate mean? The rupee exchange rate with respect to the dollar is essentially the number of rupees one needs to buy for $1. If we need to buy worth rupees $1, how many rupees we need to give? This is the rupee exchange rate. And this rupee exchange rate is an important metric to buy not just US goods only, but also other goods like crude oil, etc., which happens trade in US dollars. Most of the trade happens in US dollars only, right? Because it is a stable currency. So this rupee exchange rate is an important metric to buy not just the US goods, but also other nations' goods also, which trade happens in this US dollars. Then moving forward, and what's the other basic terminology regarding this rupee depreciation? That is balance of payments. What by balance of payments? Balance of payment is nothing but a systematic record of all its means a nation's economic transactions with the outside world in a given year. And balance of payment of India is a ledger of all monetary transactions between India and the foreign nations. It is nothing but a record of all the monetary transaction that is happening between India and other foreign nations. And in this, if dollar comes to India, if a dollar comes to India, it is marked as positive sign in this balance sheet. How the dollar flows into India? That is through exports, right? We give goods to a foreigner and in return they give us dollars. So that's how dollar comes to India. When the dollar comes to India in balance sheet, it is marked as the positive sign. And when the dollar flows out of India in the balance sheet, it is marked as negative. And how the dollar flows out of India? That is through imports. We are importing certain goods. That means we are buying some certain goods. Let's say crude oil only. If we need to buy crude oil, we need to give those nations dollars, right? So that's how the dollars flows out of India. So when the dollar flows out of India, it is marked as negative in this balance sheet, in this balance of payment. And this balance of payment consists of two accounts, that is current account and capital account. Let us discuss those also. So what is this current account mean? Current account transactions are single time and one time transactions. That means the transactions either receipt or payment happens once and then the transaction ends itself. That means if an Indian buys an American car, the dollars will flow out of BOP, right? And if the person exports goods, he or she gives the goods to that person and then they will give the dollars, right? In the payment, they receive dollars in So they receive the payment in dollars and the transaction ends there itself. This comes under this current account, that is single way and the one time transaction. And this current account consists of these visibles and the invisibles, that is trade account. In this trade account consists of trade of goods only, that means export and import of goods. This visible consists of only goods and this invisible consists of export and import of services, income and transfers. So what type of services? Transport services, IT enabled services, financial services, etc. And what comes under this income? In this comes under this dividend comes under this dividends, profits or interest from the loans and remittances also. And what are these transfers? The transfers are the grants or gifts which do not have any quid pro quo. That means once it is received, it need not be paid. That is called as a quid pro, not a quid pro quo. So in invisible consists of services, income and transfers. So the current account is a single time and one-way transaction. It is divided into two accounts, visibles and invisibles. In the visibles, trade of export and import of only goods occur here, and invisible consists of services, income and the transfers. And coming to this capital account, these are two-way and multiple transactions. This capital account is a two-way and multiple transactions. It means money paid can be recovered through periodical income or by disposal of any asset created. For example, consider India has given a loan to Sri Lanka, which is facing economic crisis and political crisis, right? India gave loan to Sri Lanka. Then Sri Lanka will pay the interest in monthly, annually, or any 5-year times or etc. like that. So it will be paid in the periodical manner, right? So that comes under this capital account. And in this also it is divided into three terms, that is investment, that is foreign investment, which consists of foreign direct investment and the foreign portfolio investor, foreign institutional investment. Also loans, that is sovereign loans or the external commercial borrowings, and the banking capital in terms of depository receipt, etc. So this is regarding the capital account. So if an American invests in this Indian stock market, that is FIIs, dollar will come into this BOP, right? That too within this capital account. If an Indian buys the American car, dollar will flow out of this BOP. If flows means there should be negative sign in the balance of payment. Dollar coming means positive sign. So this is regarding the balance of payment and current account and the capital account. Here also one more term we need to understand is that current account deficit. Current account deficit means that we are importing more. That is, imports are more than the exports. Then there is a deficit of this dollars. At that time, we call it as a current account deficit. Then moving forward, in forex reserves. We have discussed all these balance of payments, right? So now, due to this current account and capital account, if there is more inflow of dollars, there is trade surplus, right? Trade surplus or dollar surplus. So where the surplus dollars will go? It will store in the forex reserves. If there is trade deficit, that if there is more imports than exports, so there is a deficiency of dollars, right? So where the deficit need to be met? from these forex reserves only. If there is surplus, the dollars will come to these forex reserves. If there is deficit, from forex reserves, which is maintained by the RBI, the deficit will be met. So these forex reserves will be maintained in 4 terms, that is foreign currency assets, that is the currency deposits held by RBI in the foreign banks, and the gold stocks of RBI, SDR holdings of IMF, and the reserve tranche, that is India's quota to IMF. So these are all the 4 forex reserves: foreign currency assets, gold stocks of RBI, SDR holdings, and the reserve tranche. In these terms only, in these forex reserves only, the dollars will be held or stored. Then moving forward, now coming to a topic of the video. So why are Indian rupees under pressure? It is taking a hit. Is only Indian rupees under pressure? No, there are various currencies such as pound and euro have been also depreciated by more than 11%. This is due to the Russian invasion of Ukraine and the steep hike in interest rates by the US Federal Reserve to rein in inflation. So that means the Federal Bank of USA increased interest rates. Why? To contain the or to curtail the inflation, which is 40% high in the US. So the Federal Reserve increased the interest rates. So that's why there has been impact of this in all over the world. So that's why various currencies have been depreciating. The rupee slid past the 80 mark earlier this month and weakened about 7.5% in 2022. And several Asian currencies such as the Korean won, the Philippine peso, and the Thai baht have also weakened by more than 10% this year. Compared to these pound, euro, and other currencies, our Indian rupee is at somewhat better, right? It has depreciated around 7.5% only. See the data here, how the other nations have been depreciated with respect to the dollar. See, Japanese yen has been depreciated around 18%, 18.4%, and then comes the Polish zloty, that is 14.2%, then UK pound is around 12.2%, then euro is around 11.4%, and Korean won is around 10.6%, Philippine peso 10.5%, Chilean peso 10.4%, Thai baht 10.2%, and then comes our Indian rupee 7.5%. And after Indian rupee, it is Malaysian ringgit, Chinese yuan, and China's currency is better than our Indian rupee in terms of this depreciation. See, not only depreciation, there have been some currencies which are appreciated also. What are those currencies? Mexican peso, Brazilian real, and the Russian ruble. Due to the financial sanctions on Russia, there is more number of dollars, right? So these have been, the Russian ruble is appreciated with respect to the 23.1%. So meanwhile, the dollar index, which gauges the greenback strength against 6 major currencies, rose a 20-year high. And the dollar is at respect to the rose with respect to 6 major currencies in a 20-year high. And the second reason is that persistent outflows. We have discussed, right? The Federal Bank has increased its interest. So the interest rate have been increased. So what did the companies do now? The companies which were the portfolio investors or the FDI, that foreign investors, overseas investors have withdrawn from the emerging markets like India and all other nations. So that's why there is a less supply of dollars in the nations, that emerging markets or in India. So, with the increase in key interest rates by the Fed and advanced economies also tightening policy, foreign portfolio investors have been a selling spree. When the Fed raises its rates, overseas investors withdraw from riskier emerging markets and opt for safe haven assets. So now they are being investing in the US only, in their own nations only, due to this interest rates hike. And this exacerbates the demand for the dollar and leads to a corresponding excess supply of the rupee, in turn weakening the local unit. So, because of this withdrawing of these foreign investors from the overseas market, there is a low supply of dollar and excess supply of rupee. This led to the depreciating of rupee. See the graph here. In 2022, so far in 2022, FPI has dumped Indian equities worth a net amount of 28.4 billion, more than double the 11.9 billion worth of equity sold during all that of 2008 global economic crisis. Compared to the global economic crisis, in this 2022 only, the foreign portfolio investors or foreign investors have been withdrawn an amount of 28.4 billion from India. See the chart here. From 2022, it has been rising till 2008, right? Here, the global economic crisis has occurred. Then it increased, and in 2018, it has been slightly decreased. Now, see the number here, $28.4 billion have been reduced or dumped out of Indian equities. And coming to the third point, widening the gap. That is, amid a weakening rupee and rising crude and commodity prices since the war in Ukraine, imports have become costlier, which further widened the trade deficit, which peaked at the record of 26.18 billion in June 2022. And import growth outpaced that of exports, while exports rose by 23% only, but imports jumped by 58%. And in the first quarter of financial year 23, the trade deficit ballooned to around $70 billion compared with the $31 billion in the financial year 22. We have discussed, right, if there is increase in imports, there is trade deficit. So due to the rising crude and commodity prices, imports have also become costlier and the trade deficit is also increased. So this is the data regarding this trade deficit. In June 2020, our trade is just somewhat surplus. Above, it's positive, like above 1% or like from June 2020. That means it is all COVID period, right? From then, it has been decreasing only. Trade deficit is increasing. Now, it has reached around 26.18 billion deficit. Then the fourth one is deteriorating CAD, that is current account deficit. A widening trade deficit causes the current account deficit to deteriorate, which in turn adds pressure on the local currency. And incurring a current account deficit means India is importing more goods and services. We have been discussed, right? India is importing more goods and services and spending on servicing overseas borrowing than it's exporting or earning through remittances, which in turn creates more demand for dollars. So India is importing more and our exports are less, and also overseas borrowings are also more. So that's why there is a demand for dollars has been increased and the supply of Indian rupees have been more, therefore depreciating the Indian rupee. So this is the data regarding the current account balance. In financial year 2022, India incurred a current account deficit of around $38.7 billion or 1.2% of the GDP. And this is expected to rise further in future. See the trend here. In June 2022, sorry, 2019 to December 2019, there is a current account deficit only. After that, current account surplus. Then it has been, current account deficit has been increasing only. And then muted exports. Actually, a weak currency bodes well for exports as it makes the competitive. If a currency is depreciating, therefore the exports will become competitive. But now in this global economic crisis, exports are also dependent on the global demand, which has been slowing. Basically, if the currency is depreciating, exports have to become competitive, right? But there is no global demand now. So therefore, exports are also not increasing. And in June, India exported 40 billion worth of goods, sequentially a rise of just 3% increase only. And with slowing global economic growth and looming recession fears, a depreciating currency may not help spur exports, which otherwise would have at least partly bridged the widening trade deficit. So this is the percentage of exports. Year on year export percentage is decreasing only. And rising import bill. India is basically dependent on imports for crude, coal, fertilizers, and gold, right? Which these are inelastic goods. That means these goods for which demand remains largely unchanged despite the price rise. The crude oil price is rising only, but the demand is also rising with respect to the price. It is not reducing, right? So these comes under this inelastic goods. So half of India's imports depend on these goods only: crude, coal, fertilizer, and gold, which caused the rising import bill. Say imports of coal, crude, fertilizers, and gold is around 32 billion only, and including all the imports, it's $66 billion. In financial year first quarter of 2023, the imports have risen for the past 5 consecutive months and recorded a growth of 58% in June month. There has been 58% increase in the import bill. And coming to the import cover, to prevent a runaway depreciation of the rupee, the RBI deployed dollars to prop up the local currency. As there is an excess supply of rupee, right? So, to raise the demand for rupee, RBI has deployed some dollars. And the drawdown of dollars to sell in the forex market has further drawn the forex reserves, lessen the forex reserves. With the 5th largest forex reserves, RBI is well positioned to defend the rupee against the undue volatility. But however, the reserves currently just enough to finance around 9.5 months of import compared with 19 months of import in the June 2021. Now we have the forex reserves just to finance 9.5 months import only. So our forex reserves have also been decreased. Say this is the chart regarding the import forex reserves. It has been decreasing, rise and now it has been decreasing. So to sum up, why the Indian currency is under pressure? Due to the geopolitical tensions, that is Russian invasion of Ukraine and the interest hikes by the US Federal Bank to combat the US inflation, the rupee has done a downward spiral. And due to concerns over rising local inflation has also been rising in India, and a deteriorating current account deficit, foreign portfolio investors have pulled out of Indian equities, which reduce the supply of dollars in the nation. And the slowing of exports and the inflated import bill have also weighed down the local currency. And in order to iron out sharp volatility in the rupee, the RBI has dipped into its reserves, which however has led to a fall in the import cover. So due to this geopolitical tensions, increase in the interest rates by the federal bank, and due to the rising local inflation, deteriorating current account deficit, withdraw of foreign portfolio investors, slowdown of exports, inflated import, RBI's policy, fall in import cover, all these led to the depreciation of rupee. So what is the impact of the depreciation of rupee? The imports will become costlier and the widening of current account deficit, and the exports could be negative. Costlier imports add to the cost push inflation, further enhancing the domestic inflationary process, and it also hurts the foreign investors due to the interest hikes by the Federal Reserve. Already the foreign investors have been pulling out of India, but due to this all current account deficit inflationary process, this domestic process will also aid the foreign investors to pull out of India. So these are the impacts of weakening Indian rupee. And what's the way forward? The experts say it is neither wise nor possible for the RBI to prevent the rupee from falling indefinitely. It, however, due to the global economic situations, it, however, falls. So, defending the rupee will simply result in India exhausting its forex reserves. This has happened, right? To defend the rupee, the RBI's measures have finally lead to the reducing of this forex reserves, because global investors have much bigger financial clout, and most analysts believe that the better strategy is to let the rupee depreciate first and act as a natural shock absorber to the adverse terms of trade. And RBI, which is the charge of monetary policy, should focus on containing inflation, and the government should focus on containing its borrowings. So this is the only way forward to mitigate the negative impacts of weakening rupee. RBI to contain inflation, and government should make measures to lessen its borrowings. So with this, we'll end the session here. If you like, please like and share. Thank you.